Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 156 on March the 6th of 2021. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Fisker Inc., Uber Technologies, and Carnival Corporation, otherwise known as Carnival Cruise Line. And we discussed three new trades on AMC Entertainment, the SPDR S&P 500 ETF, and the US Oil Fund ETF. And that's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the U.S. equity markets finished the week higher once again this week. The Dow Jones Industrial Average gained 563 points, ending the week at 31,496 points. The S&P 500 index gained 30 points, closing the week at 3,841 points. Now it's time for the topic of the week. And the topic of the week this week is weekly options. Now, even though this show is called the Weekly Option, we typically, and when I say typically, I mean like 100% of the time, focus on monthly options. So monthly options, specifically in the US, expire the third Friday of each calendar month. Weekly options are the options that have expirations on any other day, typically the first, second, or fourth Friday of the month. There are some equities out there that have option expirations in the middle of the week as well, but we're not really going to focus on those either. So all of the usual strategies we look at can be done using weekly options. You can trade credit spreads, debit spreads, iron condors, straddles, strangles, butterflies, ratio spreads, covered calls, naked puts, covered puts, and so forth. The only difference is that the expiration is different from the monthly options. And that makes them perfect sometimes for shorter term time spreads. We know that time is one of the components of finance, and hence one of the things that is used in calculating an option's value. So being able to play with time for different spreads can be very valuable. So I've always been a fan specifically of selling the weekly options because they typically overprice the volatility component of option pricing. So volatility is another piece, and being able to accurately calculate volatility in shorter time spans is a lot more difficult than, say, calculating it over the course of a year. So I like creating time spreads where I sell the weekly option and buy the monthly option. Like with this being March expiration, so expiration is on March the 19th, maybe I would sell the option expiring on March the 12th in order to finance the option that expires on March the 19th. So I value the strikes so that if the weekly option gets called or ends up in the money, I can exercise the monthly option and deliver against the weekly option. If the weekly option expires out of the money, I, of course, get to keep the premium for having sold it, and then I just look to sell another weekly option against the option that I own, typically the monthly option. So in this scenario, selling the premium from the weekly option actually does finance, it pays for the monthly option that I own, giving me the possibility of having some free upside or less expensive upside. So there are dozens of other ways to trade weekly options to your benefit. And, this is actually, today marks 3 years of weekly podcasts. So thank you guys so much for listening. And I'm looking to add a couple things to the show. So if you guys would like me to add a weekly trade a weekly option trade to the show each week, send me an email. Let me know if that's something you'd be interested in. All right. So let's get into the trade review of last week's trades. And I'll admit this was not the best performance week, but I'm actually kind of hopeful on a couple of the trades. But overall, the last 7 days, or really the last 5 trading days, did not treat me so well on these 3 positions specifically. So we'll start off with the covered call. We looked at Fisker Inc., symbol F as in Foxtrot, S as in Sierra, R as in Romeo. The stock at the time was trading for $28.50 per share, and I looked at buying stock and selling the March 29 call at $4.10, hoping for a return of 16% in 3 weeks. Well, Fisker stock really tanked this week, big time. The stock fell $7.20, ending the week at $21.30 per share. The call option we sold can be repurchased for 64 cents, marking a gain in profits from the option of $3.46, which is pretty huge, but it still leaves us with a net loss of $3.74 because of that very large down move in the stock. So if you held on to the stock, and that's if you held on to the stock, that's a huge caveat because you always can exit these trades earlier, all right? You don't have to wait for a full week. You can exit a covered call early if you want to limit your overall losses. You definitely don't want to wait for a 25% drop in the stock price to decide to take action. Now, you can certainly buy the call option back and roll the strike down to the 21.5 strike. That would allow you to at least collect another $1.90 per option, and that would lower your overall loss down to $1.84 on this trade if you held on to it. You can collect more premium for selling longer dated options, meaning options in other months, but I would only do that if you truly want to hold on to the stock. If you're not committed to the stock, if you don't believe this stock has some huge upside potential in the future, I would look to make decisions that will allow you to exit this trade over the next 2 weeks when the March expiration happens on March the 19th. So that's number 1 on the week, the covered call. Next up, we have the credit spread. We looked at Uber Technologies, symbol U as in uniform, B as in Bravo, E as in Echo, R as in Romeo. At the time, the stock was trading for $51.75 per share. I looked at selling that March 52-53 call spread at 33 cents, which can give us a maximum loss of 67 cents. Well, Uber stock grew $3.79 per share, closing the week at $55.54. The out-of-the-money call spread we sold is now in the money, so the spread is actually being valued at the full $1, which means that we've lost our full 67 cents on the spread. That was our maximum possible loss on the spread. That's one of the reasons I like trading spreads, is because right from the start, we know what our downside, like if the world goes crazy, the most I can lose is 67 cents, and we're there. Now, there's no real reason to exit this trade early because we still have a couple weeks left before expiration, and this stock could end up dropping again. Of course, it could go higher, but even if it goes higher, we can't lose more than 67 cents. We've already lost that. So you might as well hold on to the trade and see if this stock ends up falling again. Now, if you decided to create an iron condor, which is what we normally would do, you really want to trade a put spread. You'd sell a put spread that has strikes lower than your call spread. And right now, if we sold a put spread that's closer to the money because it has more value, there's still a possibility that if the stock fell $1 or $2, you would end up losing money on both spreads, thus doubling your losses. So for now, and unfortunately right now, the lower strike put spreads, because they're really low now, if we were to sell like a 52-51 put spread, that still is several dollars out of the money. It's $3.5 out of the money. So that spread doesn't have much value. So unfortunately, I would just hold on. I would look to wait to see how the stock does over the next 2 weeks. We price these trades so that we can handle, these occasional losses. And it's not that I brush them off. I mean, trust me, it pains me when I lose money, any money, even if it's only $67 out of my account. I don't like losing money. But right now we're facing down our maximum loss, right? We're looking it in the eye and saying, okay, well, we've already lost the $67. There's nothing else we can lose. So this is the bottom of the barrel for this. There's only upside at this point. So I wouldn't look to make any adjustments at the moment. I would look to see if this stock is going to fall some, because all it has to do is fall, a few dollars, and our call spread will be back out of the money, and we could end up still winning, being able to close out this week or this trade with a profit over the next 2 weeks. So for now, not going to make any adjustments. Depending on how you like to manage your own risk, you'll have to make a decision. But again, you're looking at the worst of it right now. The worst, you're at the bottom. The valley doesn't go any lower. So the way I look at it, there's only upside to possibly hit the mountaintop. So that's it. Final trade from last week was a debit spread. We looked at Carnival Corporation, symbol C as in Charlie, C as in Charlie, L as in Lima. At the time, the stock was trading for $26.75 per share. I looked at buying the March 26 half call spread for 33 cents, hoping for a maximum return of 17 cents, which would be a 51.5% return in 3 weeks. Well, Carnival Corporation fell 66 cents this week, closing the week at $26.09 per share. The in-the-money call spread we purchased is now at the money with a loss of 16 cents. Now, you can always look to sell a higher spread to collect some premium. However, if the stock rallies, which is what we are initially expecting, the short call spread would likely lead to a net loss on your entire profit, on your full trade. So this is a trade I would absolutely hold off on making an adjustment for. If you think the stock will go higher, you could certainly gain back what was lost this week, plus some additional profit, right, if stock rallies a bit. So some of you might wonder why I don't suggest selling a put spread. Well, it's because owning a call spread and selling a put spread are both bullish. Those are both trades that increase in value as the stock increases. So that means that the put spread, selling a put spread, cannot act as a hedge. The only hedge against buying a call spread would be selling a call spread, ideally a higher, further out of the money call spread. But again, if you got a pop in this stock, you could end up losing money on the full trade, even though your original trade thesis worked. So I'm going to wait a little bit before I make any decisions on any of these, or either the credit spread or the debit spread. And I still am positive on the outcomes of these trades. But that being said, I'm also, always thinking about how do I lock in profit, and or how do I limit risk. So, I'm not going to let this debit spread go all the way down to zero. That's just not what I'm going to do. I would look to exit it early, but I want to give the trade a little bit of room and allow it to come back and make a profit. And if not, I'll definitely look to exit early. So that's it. We're going to go ahead and discuss the trades for this week. I am an eternal optimist, which is positive and negative. Of course, being a trader for the last coming up on 20 years, has made me more of a realist. And, I love it when people tell me they're a realist. Oh, Eric, I don't smile because I'm a realist. And I'm like, no, you're actually just negative. The opposite of being an optimist is not being a realist. Trading has forced me to be more of a realist, and I'm defining that by saying, even though I put a trade on, every trade I expect to be profitable. So I'm optimistic. Otherwise, I wouldn't use my capital or firm capital for that matter to put towards a trade. So I always believe in my trades, but I always am aware of the possibility that I can lose money. So I try my best to think about how I'm going to prevent or limit loss right from the start of the trade. That's what makes me a realist when it comes to trading. I'm always hopeful, but I'm looking for ways to limit risk. And that's why I like spread trading over just, outright, trying your best to buy an option and watch it go up or sell naked calls or something like that, which can actually blow up your account pretty quickly and efficiently. I've seen it happen before. So that's it. Let's go ahead and get into the new trades for this week. We're going to start off with a covered call, looking at AMC Entertainment Holdings, symbol A as in Alpha, M as in Mike, C as in Charlie. This is one of those stocks that was part of the Wall Street Bets sort of movement, if you will. I mean, maybe we call them a movement. I don't know. But it's had a little bit of volatility. It's gone up. It's come back off some. And I'm looking right now at buying that stock. Stock's trading for $8.05, and selling the March 8.5 call at 92 cents. And again, these trades that I'm suggesting are trades that I'm looking at for the week are using the monthly options, which expire on March the 19th. So selling that March 8.5 call at 92 cents, that could create a 17% return on capital in 2 weeks. Now you enter this trade by buying AMC stock for $8.05 per share and selling the March 8.5 call at 92 cents. This trade makes the most money if stock prices finish above $8.50 per share. The break-even price on this trade is $7.13. In real terms, the stock purchase would require $805, and you would collect $92 for selling the option. Our next trade on the week is a credit spread. Looking at one of the ones that I've always liked. This is the Spider S&P 500 ETF, the SPY. S as in Sierra, P as in Papa, Y as in Yankee. The ETF ended the week at $383.63 per share. I'm looking at selling the March 389-390 call spread at 36 cents, which could give us a maximum possible loss of 64 cents. Now you enter this trade by selling the March 389 call at $3 and concurrently buying the March 390 call for $2.64. This is a credit spread because we are selling this spread. And this trade makes the most money if stock prices remain below $389 per share. The break-even price on this trade is $389.36. In real terms, you'll collect $36 for each spread that you sell and have $64 per spread at risk. Our final trade on the week is a debit spread on the US Oil ETF, United States Oil Fund ETF, symbol U as in uniform, S as in Sierra, O as in Oscar. Stock ended the week at $44.44 per share. Looking at buying the March 43.44 call spread for 68 cents, which can give us a maximum gain of 32 cents, or that's a 47% return on capital in 2 weeks. Now you enter this trade by buying the March 43 call for $2.02 and concurrently selling the March 44 call at $1.34. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $44 per share. The break-even price on this trade is $43.68. And in real terms, you'll pay $68 to enter this spread, and your maximum gain is $32 per spread. So that's it. Thank you guys so much for following and listening each week. Some of you have been doing this for the last 3 years. You are amazing to me. So thank you very much. Definitely reach out. Give me any suggestions, anything that you'd like to hear on the show. If it makes sense for the larger audience, I will definitely add it. Let's think. I can think of a few things that I've adjusted over the years, added different types of trades. I started using the sort of military alphabet system. If you listen to the first episodes, I used to kind of make them up, names and fruit and whatnot as I went along. And there were a couple of people that emailed me and said, that's driving me nuts. Can you please make this change? And I did. So I definitely want to make it the show that you enjoy each week. So thank you for listening. Thank you for sharing it with your friends. And thank you guys for the email. I'm a little behind in my email, but I'll be catching up ideally this weekend or in the coming days. So that is it. Let me know if you'd like me to add anything else. And thank you so much for following along with me on this journey. Have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.